There are 5 stages of grief associated with stopping out of a trade. Stage 1. This is a great trade. Stage 2. That's not quite moving to my profit target. Stage 3. Oh my gosh. Stage 4. Oh, I should have closed that trade out. And stage 5. However, stopping out of trades doesn't have to be all that bad. It doesn't have to make your hair stand up on end. There actually can be a lot of joy associated with stopping out of a trade. And that's what we're going to talk about today. So if we jump on over here to the chart, I want to show you something. Here is one of the systems that I've been talking about recently on YouTube videos. And you can jump back through YouTube videos and look up reversal tabs. But when you have 2 of these bad boys in a row, whether it's a stock or whether it's a currency or it's a commodity or, whatever it is that you trade, cars, drugs, whatever it is, and you get 2 of these bad boys in a row, that's a really good signal. Okay, so, and I mean, by really good signal, I mean something that still only has a probability of success, but isn't necessarily a sure thing. And let's say that I buy here on the formation of these 2 tabs. And let's say that even I've done a ton of back testing and I followed all of the rules. Let's say that I did that. In fact, one of our friends wrote in and said, hey, this might make a good video for people. Someone wrote in saying they took a trade, followed all of the rules exactly, and was surprised to see that it got stopped out. They seemed truly shocked that it could have lost. Of course, I wrote back saying that not every trade will win, and statistically the strategy wins over time, blah, 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 but that might be something worth addressing. Well, it certainly is something worth addressing, and I think it's a great question because sometimes we learn a trading system, and then that trading system, as successful as it appeared in backtesting, maybe in backtesting it won 70% of the time, but maybe as you actually trade this strategy live, maybe it only wins 40% of the time, and you get a big giant frowny face on your, here's me, here's my hair. You get a big frowny face, and then tears start to stream down your eyes, and then you get really mad, and so you pull out a giant knife, and you're like, I'm going to destroy the markets. You get vengeful and angry and whatever else. Well, here's an example. Here's 2. This is a trade that I got myself into recently. And there were the reversal tabs. And I bought. And this is supposed to go up pretty immediately right after. And here's where my initial stop loss was, right below the lows. It's a common place where people put stop losses. It's common stop loss. And then right away, bada boom, bada bing, it hit the stop, or at least it hit the number that I said I was going to stop out at. And this is where the giant paradox, the giant question, the giant dilemma happens. Do you put the stop loss in as a hard stop in the trading platform? And if you do that, you're abiding by the rules set down in stone, carried down from the mountain by all of the trading gurus who never traded but lived before us. And they have all these platitudes and stupid things that they say all the time. And they tell you, you gotta have a stop loss in your system, and you gotta blah, 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 blah. And so that's the first characteristic of it. And if that's what you do, fine. I ain't got no problem with that. I have no problem with that. And you go ahead and you stop out of that trade. But I think it's a good moment if you do that. I think that's a happy moment. And here's why. If you stop out of that trade, what you immediately do is you put a line above where the highest point where price was before it stopped out, and you buy this again. You go after it. You go get it. And in fact, your first trade size is half as big as you can possibly take. And then the second trade size, when you take that second buy trade, it's the full trade size that you could possibly take. So on the first probing position, you don't lose money. On the first experiment testing out the position, you don't lose money, as much money. And then the second time around, you take the full position size because it's more likely to actually succeed. You see, in every single trading strategy, even ones that have a probability of success, there's a variable rate of stopping out. There's a variable stop out rate, meaning your backtesting can show you whatever the crap it shows you. It doesn't really matter what the backtesting shows you. Forward testing, going forward in time, the market might need 5% more or less of a stop loss in order to have a successful trade. And so you can't really know what your stop loss is going to be, and you can't really know what your statistics are going to be with complete accuracy, even if you've done all the testing in the world. So you take a first position size that's a little bit smaller, and then you feel super happy when that position stops out. You throw a party for the market when that position stops out, because you're gonna take the next position on that trade with a full position size if it breaks back through the barrier and takes off. Let me review that one more time from a different perspective. Let's say that you take a 0.5 trade size here. And let's say that this never happened and the price never dropped below the stop loss. But it did rise up to this level here on the chart, drop back down a little bit, but it never hit your stop loss, whatever it is. Let's just say it never hit it. As soon as it rises above this level, you take that full position size. And I use a 1.0 to designate that position size. Maybe your full position size is 10 lots. So half your position size on the first trade is 5 lots. Or maybe your full position size is 100 shares. So on the first trade, you take 50 shares. So 1.0 refers to the full position size and 0.5 refers to a half of a position size, whatever that might be. So if you take that first position with half the position size and it doesn't stop out, and then it creates this little barrier above where your trade was going, and then it rises up above that barrier over here off to the side, then you add to that position and take the full position size. That's just another way of looking at the same thing. I have this opinion that there should be joy associated, the joy of stopping out. So I'll just give you a little lecture, a couple side notes, a couple thoughts about that right now, and then I'll let you go. But I just want to say this. Most people view stopping out as a negative. They view stopping out of a trade as a bad thing. They view stopping out as a loss, as a binary winner, loser, bad guy, good person, good trader, bad person. Oh, you got to stop out. It's a bad trade. It's a bad system. I'm a bad trader, or whatever. And the reason that they feel that way is usually traders are taking massive position sizes, the full position size available on that first trade. And if that stops out, it's meaningful. But no single trade should ever matter. No single trade should ever make or break you. It should never make a difference in your income level if you've stopped out of a trade or not. The second point is this. If you stop out of a trade, it's an opportunity to get back in with a full position size once the market actually proves that it wants to go where you want it to go. If you subscribe to the opinion, and many people do, that there's manipulators and all kinds of funny business going in with the market, then play along with that. Take your first position size smaller. Let the stop outs happen. Let the stop hunters grab your trade, stop it out along with everybody else, and then you go right back in with those market makers or dealing desks or whatever else, and then you stick it to them because they're not going to be able to do it twice. Once that thing takes off, it goes. Here's what happens, or used to happen in advance of the news. At an investment bank, they'd pick up the old banana phone and they'd go, hey, yeah, Bob at manufacturing company XYZ, I'm thinking the euro's a really good buy right now. Yeah, I think you should jump into a bunch of euros. And then the news comes out and this broker, welcome to I started playing something. Then the news comes out and the broker forces the price it down, stops out Bob from manufacturing, but the broker's still in and price takes off in the opposite direction. Well, follow along with that. Go ahead and take the first trade. But if it stops out, that's an opportunity in disguise. Most people, when a trade stops out, have lost everything. The largest single loss that most people take is their entire account. But if on average the largest loss you take is 0.5% of your account or 0.25% of your account, you're going to survive. You're going to do fine in most cases. The third perspective on it is, don't put the stop in there. Just take a tiny, tiny position size. Start your trade off with 1/10 of the available position and a stop loss, a massive stop loss that's 10 times bigger than what you originally planned. And then if the trade goes against you, nobody cares and you don't worry about it. And then if the trade starts to go in your favor, you start adding to what is successful. Most people will add to what isn't working and they'll take away from what is working. They get scared when the position is a winner. They get scared when the position is a winner. That's terrible. And they get confident when the position is a loser. So what I do with a lot of my trading strategies is I take a really tiny first position size, and then I'll take a really small second position size. And then as the trade starts to go in my favor, then I can start really piling on the full trade size. So in other words, stopping out is kind of an opportunity. There's a lot of lessons in stopping out. There's a lot of market information in stopping out. And it's not all bad. Thanks for watching. Thanks to our sponsor, Forest Park FX. If you're interested in trading the currency market, contact Forest Park FX to receive cashback rebates on every trade you place. Contact forestparkfx.com. That's forestparkfx.com. Forex trading carries significant risk of loss. Terms and conditions will apply. Thanks for watching, everybody. I'll see you on the next one.